Good afternoon, everybody. Welcome to Trader Merlin Show for your Thursday edition. The final show of the week. As you guys know, I will not be doing a show tomorrow, as I will probably be in a sea of patchouli oil and hippies up at the Hollywood Bowl at a Fish concert. So, no show for tomorrow. This will be the Friday show. And unfortunately, I don't have a glass of whiskey, as I would normally like to have a glass of whiskey for you all on a Friday afternoon. But this is my Friday. So, hope you all had a fantastic day. As you saw from the graphic to start off today's show, third bullish day in a row. Something we don't see that often, especially in the midst of such chaos and volatility and just not knowing which way our administration is going to go, or a Trump tweet could send us reeling one way in direction to the other. We had our third great bullish day. I did not think we were going to get this. I actually thought we were going to see a bearish day today. So fortunately, didn't make any trades. I'm still holding out on the positions I have for Friday. We'll see how they all expire. But all in all, looking pretty good. Casey, when he says it's Captain Kirk, it's James Tiberius Kirk to you. Yeah, I got this shirt. It's a little bit Star Trek-ish. I should get the little communicator pin and, beam me up, Scotty. All right, here is the chart of that S&P 500. Remember, yesterday we talked about the shooting star formation below 53.77. That was kind of a key point, and it actually did tiptoe below that last night. But if we follow the rules that I've been talking about, which is waiting for regular market hours to open, that low, that break happened right around 12:40 in the morning. So it really never actually got a trigger for me because my rules has to happen during regular market hours. That said, we were pretty much bullish all day long. There was one little blip here near the tail end of the day. All in all, a fantastic day. And I guess we could ask, what were the catalysts there? What were some of the drivers? Well, to begin with, we could look at economic data, and that is going to start us off with things like durable goods orders. For those that don't know, durable goods orders are items that last 3 years or more. Refrigerators, TVs, airplanes, stereos, things like that. In the midst of this trade war, where we are all thinking that, oh crap, China is going to, face these huge tariffs, and same thing for Korea and Japan and Canada and Mexico, and all our goods are going to go up in value, a lot of businesses said, hey, listen, I normally order, let's say, 15 refrigerators a month. Give me 100 refrigerators, because I want to get ahead of the curve here. The reason I bring this up is you have to think there's two issues that are going to come from this, which I think could potentially lead to a much bigger move in the future. So put yourself in the position of you're a business, and you know that your costs are going to go up. You don't want to raise your prices to your customers and pass that on because they may go elsewhere. So you buy more inventory right now. This actually drives demand for products out of China or Vietnam and Cambodia because they're getting hit with a lot of tariffs. So if you're that business, you now have this stockpile. Your hope is that your consumers buy all this inventory that you've now procured at current prices versus potential future tariff prices. So where do we see that number reflected? Well, we'll go out to your Forex factory here so I can show you the latest data there on durable goods orders. The previous number was 0.9, and I'll show you the chart here. There you go. Previous number was 0.9, and the expectations were that we were going to jump to 2.1, meaning that a lot of U.S. businesses are buying more goods and services, buying more durable goods, just to stockpile and get ahead of the curve. Well, if you look at the actual number that came out today, 9.2%. This is scary and good and scary at the same time. It's great because when you have that big of a demand for durable goods, obviously that's going to be drive equity prices up because it's showing that it looks like businesses is absolutely fantastic. People are buying all this inventory. We're the roaring 20s. The reason they're buying that is the tariff war. If the tariff wars get resolved right away and everything turns out to be okay, businesses may be stuck with a bunch of inventory that they may not be able to move, or their upfront costs are so high right now it could put them in a precarious position. So, yeah, exactly, Liz. Front loading. Right? Front loading. It's kind of interesting the way we saw that surge. That number is massive. The last time we saw a number that high was back in August of last year when we hit a high of 9.9. Other than that, it was COVID was the last time we saw numbers anywhere close to that 10% mark or 10 mark. So I thought that was one of your major catalysts for today. That does echo in this era of optimism where people are going, oh, this looks great. Markets are great. People are buying. Yes, let's go, 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 go. All right, that sounds great. And then that couples up with the trade war topic, which is one we've been discussing many, many times. With Don jumped in here, huh? Oh, mowing the yard. Oh, great. I'll torch you with the headphones on. I'll give you a slow droning just so you can hear that in your headphones. But good to see you, Don, and everybody else here today. So if we do get the trade war resolution, again, I don't believe it's going to happen overnight. I think we're talking a few more months before we get it all resolved. I mentioned on this show yesterday and the past few days that once we have definity and clarity on trade war, tariffs, all that situation, markets are going to rock. They're going to absolutely surge. And the longer we go on, the worse the situation is going to get. So optimism abound because President Trump, again today, reiterating, look, we're going to resolve it. We're going to come to a solution here soon, right? That was kind of his general tone. So all in all, very good. Now, I'll run through our top 8 markets like we normally do. We'll run through those and give some, ideas of where we may be headed, even though I was completely wrong on direction today. I'll start at the bottom and work my way to the top. That 10-year bond, great down move today of 1.6%, dropping the yield on the bonds to 4.31%. Technically, though, if you look at this one, all right, it's tough to name a picture or a pattern or formation that fits this one. But if we do look at the bullish flag synopsis, which is an impulse move followed by a retracement in price, notice that from the 4th of April through the 11th of April, massive move, an 19% increase in the yield on the 10-year bond. Love it if you're buying bonds for the long haul. However, after that, we saw a pretty significant sell-off, but we are also seeing at the same time the lows on the yield are getting higher and higher. Yes, we do have this little breach here on yesterday's session, but you could argue you're kind of in a loose pennant formation. I still am in the camp of I go back and forth. I feel like I'm a politician because I flip-flop all the time. I feel like I should be bullish on the yield and then bearish. Based off this picture, I feel like I should be bullish on the yield, meaning I think yields are going to go higher, and that may have to do more with people selling bonds and liquidity coming into the marketplace. The higher this goes, the worse it is for your economy, the worse it is for real estate, and the worse it is for getting loans. The lower this goes, the better all around. So you know that Trump and Besant and others are pushing for this to get as low as possible. So you have this not so invisible hand of government pushing this one lower, but technically, if you go to Steve Nissen's books or you go to Martin Pring's books on technical analysis, this is a bullish pattern here, which should move to the upside. Time will tell. Trump was smart not to kill Apple. Not just Apple, let's be honest. A lot of companies could have been, well, still not out of the woods yet, but certainly giving some reprieves on tariffs for technology did save that market segment. And I think Trump is aware enough to realize that I can play hardball with tariffs, but if I do go too heavy-handed, I could seriously hurt this market, more importantly, the economy, and that could cause big backlash on me. So it's shock and now backpedal. And we'll see, hopefully, not hopefully, but we'll see if another shock factor comes to the market here in the next couple weeks as now everything seems to be great. No, it seems great. I think there are tariffs on cars or tech. It's the base 10%. I don't know, it seems like it changes every day, Steven. So let's go into your second place, or second from the bottom. That's that dollar index. We talked about the dollar most likely having a sell-off today, and it did. Why the sell-off? Well, because we were stuck in between these two yellow bars here. That channel of demand down between 97.69 and 98.31. That's our low point, and we rallied up in 2 days all the way back to the supply zone between 99.63 and 127. So that kind of defined our range-bound move here for the dollar index. I anticipate selling off and getting back down towards that 98 level because the trend is your friend until the bend at the end. And if that continues, more downside movement for the dollar. All right, Bitcoin, not as exciting. Even though there was volatility on today's Bitcoin price movement, it was kind of boring, honestly. Ultimately, right now, we're unchanged. 0.14% gain for Bitcoin, 94,460 on the futures market. I am very bullish, though, on this one long term, and I will keep reiterating that one. I know you guys have asked me what the probability of a $250,000 price target by November. And yesterday when I did the poll, I do believe that 61% of you said not going to happen. There's no way that Bitcoin could rally 229% or whatever it was by November. And we will see. Time will tell. In this case, I really hope that I'm right because a 229% gain would set me up for the year. That's sure. Margaret says, so did we miss the most profitable long-term demand zones in tech? I guess that's all in the eye of the beholder there. We'll go back and look at XLK or QQQ here in just a minute. Let me run through our top 8, Margaret, and then we'll go into, did we miss it? Yeah, some people feel that the bottom is in, that we're done, and it's just booming trend from here on out. I'm not in that camp. again, I've mentioned this before. I think that we're going to see it drift lower. I think we've got some S&P supply zones coming up that we should pay attention to, but I'll show you those in just a second. All right, let's keep on moving up. We're getting the dollar, the bond, the commodities out of the way. Here is crude oil. Crude oil had that pretty big red down day yesterday. Today bounced up just a little bit, 0.84% to 62.79. Again, technically, nothing exciting here because it's slowly drifting higher, but I don't see anything here that puts a high probability trade in my favor. All right, it's indexes and gold taking our top batch here. As you can see, we had that shooting star yesterday, which I drew that line on the Russell 2000 at 1917. We did breach it at about midnight last night, but not during regular market hours. So nice up move there today. 1.99% gain for the Russell. You know, the good news here is it's the highest closing price that we've had in the Russell since going back into early April. So it's been a month since we've had prices this high. That's a very reassuring sign for those of you who have long-term portfolios or are bullish at all in our marketplace. Andre has asked if we are out of bear market territory. Great question. Let me get to the S&P and we'll discuss that there. Your bronze medal winner for the day, podium time, it was gold. GC, we had a 1.65% move up in gold. Remember, we talked about this pullback here. I thought we'd actually head a little bit lower, getting to right around 3,250 on gold. Well, we bounced up today. We're now at 33.48. This is a bullish Harami formation, although it happened after a 2-day slide. Typically, a bullish Harami like this would be after a much more prolonged downtrend, but technically these two candles together do represent a bullish Harami, and that might lead to more upside move tomorrow. Again, this level here you see on the gold futures chart is at 3,379. A breach above that should give you a fast track to all-time highs. For those of you who hold gold, I know you like that. Okay. Second place, silver medal. We've got the S&P 500. This is 2.03% gain for the day. I've got several different lines on the screen here, so let me try to explain what those are. That blue line you see at 5,509, that was that breaking point that I thought that if we break this one, you're going to see some big downside movement. And we did, right? We fell from 55.09 all the way down to 49.26. So pretty big. I did not short the shooting star, Margaret. I just mentioned that one. The reason I didn't short that shooting star is it didn't happen during regular market hours. That's one of my rules. So no. If you look here, let's go look at that ES, right? Because you look at this picture and you're like, well, Merlin, it tiptoed down below it. Tiptoe down below 53.77. That was the short you said. Yeah, but I have also said many times, for me, it's got to happen during regular market hours. And notice where we opened up today. We opened up much higher than that. We were at 54.08. And the lowest point during regular market hours was a low price of 5,378.5. So unfortunately, did not actually, I guess fortunately, right, Margaret? And that's part of the reason I have these rules is it did trigger down here. You could argue there's multiple points where it would have triggered. One about 10:55 p.m. last night and then dipped below it again right around midnight, 1 o'clock in the morning. But for me, it's got to happen during regular market hours. And I know that there's a lot of people who will trade and put in after hours orders because the futures markets are quasi 24. You could put in orders, limits, bracket orders in the after hour session, but I don't. I already have enough insomnia and issues, and having an unknown, uncertain order, even if I did a bracket order that could happen at any hour of the night, sometimes makes me more of an insomniac. I'll just say that. So that's part of the rule there, Margaret. Yep. You know, and I know what you're probably thinking, what many are thinking is, well, Merlin, if that's the case, you know, you probably would have said something like, oh, well, if it worked, right? If we saw a big down day, many of you be like, oh, well, you know, you probably took that trade and you're going to say that you did. No, it's regular market hours is what I'm looking for, right? So even if it sold off and had a massive down day today, I still would have said I didn't make the trade. The rules are it has to open up above that level and then break down. That's my shooting star rule, right? I've mentioned that many, many times. Maybe I need to do a show exclusively breaking down the rules for shooting stars. Might be a good one for everybody. Okay, so one more here, and then we'll go more in depth and talk about the bottoms. Are we in? Price turned around in the gap. It did. That was your second place, 2.03%. But the real star of the show was Nasdaq, 2.75% jump up today on the Nasdaq, closing at 19,322. All in all, very interesting point for the Nasdaq. You notice when I zoom in here, I'll put a line right across the highs for about the past 3 weeks worth of trading. And you can see that's 19,383.5. Today, we hit 19,418, and we're closing below that line. So we have not broke above that. It is my opinion. I do think we'll see this gap close, so I could see it going to 19,752, somewhere right in that ballpark. Technically, what you have here, I know you have some technical analysis people in here. This is a cup and handle formation. There's a cup there, the large cup that really started back on April 2nd, bottomed out on April 7th, and then reached the top of the mug on April 9th. Then proceeded to sell off again, not going as low. If you want visuals, I know a lot of people like when I do the visuals, so let me draw it for you. Here is your cup, and then we'll draw the handle. The whole point here is the handle reflects that prices aren't going back to where they were before, as low, right? Not as low. And then, as Margaret puts out very astutely, it's an ascending triangle. Now, typically an ascending triangle is during an uptrend. We don't have that here. We've actually got a downtrend. So in this case, it is technically has the same mechanics, Margaret, as an ascending triangle. I'll call this a cup and handle, but if it did it one more time, let's say it did this and then move back up, then this would be your ascending triangle. So yes, it's an ascending triangle, cup and handle, double-fisted Starbucks, whatever you want to call this damn thing. It really tells you psychologically what's going on here, right? And I think everybody, if you look at the screen now, it will tell you that the buyers are in control. Even though we're not breaking that high level line, that top line, the buyers are in control because every time it tries to sell off, it doesn't go as low. It's showing strength by not falling as far, right? So that's the power of this ascending triangle or cup and handle, whatever. Psychologically, it's telling you that the buyers are getting more confident. They're not letting it fall as far. So those people like myself, they're going, man, I want to buy it at a discount. I want to buy it cheaper. They're not waiting for it to go lower. They're like, this is good. I'm buying right here. And that causes prices to move back to the upside. So this is a very, very, very positive sign, not just for the Nasdaq, but you can see also the S&P having a very similar formation. I did see comments here about the Russell 2000. Yes, a similar picture. And if in fact the Russell is the canary in the coal mine, meaning it's the one that leads the markets, today's a really good sign. Right? A very good sign, seeing such a big rally in the Russell, but also breaking through these most recent highs like back here in April. The Russell is above those highs, the S&P is not, and the Nasdaq is not either. They're both right at those highs. Liz says, very likely NQ will go higher tomorrow after Google's earnings tonight. Well, thank you for the segue. Let's talk about Google, shall we? Here is Google's earnings Alphabet. I'm still going to call it Google until the day I die because that's what I'm using. I don't log into Alphabet. I'm using Google. But Google had some pretty good numbers. Let's start off with the good news. The good news was their earnings per share. They came out at $2.81 versus $2.01. That's a big beat, right? The concern was, for many people, that their advertising revenue may slow down. Well, that's not the case. Advertising revenue topped out at $68.8 billion. The expectations were 66.4. So while the growth isn't astronomical on ad revenues, that's still great, right? I mean, pulling $66.8 billion out of the quarter in ad revenue is unbelievable. But there's more. So the next big piece here was their cloud platform revenue. That was okay, $12.2 billion versus expectations of 12.3. So this, I put good news on here. That's actually kind of negative. We slightly missed on that number. So that's not the best news in the world that they missed on the cloud computing, but not bad because a lot of people were saying their cloud computing is going to suffer due to all the competition. 100 million, it's a rounding error for Google. So I would argue that's your good news. The great news though is, as I saw some people type in a chat here, two things. Number one, they raised their dividend by 5%. So for Thomas here, who's the dividend doctor, the guy, he's not here today, but you remember he's the one that always logs in. He's always in stocks in aggressive downtrends that look like it's falling off a mountain, right? He's the Mount Everest of buying. He likes to buy at the top, and as prices decline, he goes, "Oh, it's okay, it's declining. I get a dividend." Look, the dividend is interesting, and let's explain why this is so important. I think it tells volumes about Google. So two things. Number one, their dividend was increased by 5%. Number two, and even more importantly, $70 billion stock buyback. Uh-oh. Oh, hopefully it's not spinning now. $70 billion stock buyback. Now, those numbers sound fantastic. They are. But here's the problem. Remember, when a company makes money, so let's say I've got Merlin's widgets and I make the best widgets in the world. People love my widgets. When I make money, my whole goal is to make as much money as possible. Now, the first thing I'm going to want to do is I'm going to take that money and I'm going to invest in research and development. I'm going to build new infrastructure. I'm going to buy new factories. I'm going to hire new employees. I need that kind of incremental growth. That's where I'm taking my earnings and putting it into that, because I know that if I take that dollar, invest it in my company, I'll make a lot more. At a certain point, your executive team may look at that and say, hey, Merlin's widgets, if you take that dollar and put it into the business for economic growth, for incremental growth, we just don't see the growth there right now. Where else am I going to put it? I need to find some way to incentivize you, the consumer, to buy my shares and drive prices up, because that's how I'm making money as a CEO. Yeah, I make a nice salary, but it's the stock options that really kill it. So if I don't believe that that dollar is going to make me a better rate of return in building my company, I now need to invest in some way to get you to buy my shares. How do I do that? I raise my dividend, because clearly when I raise my dividend, the average retail investor is going to look at it and go, well, shoot, I can get 5% more dividend now with Google shares. I'll buy some of that because I want dividend. The other part is, how do you drive your share price up? This, to me, is the dirty secret of the trade world. It's, in my opinion, outright manipulation that should be outlawed and banned, but they don't do it. Here it is. Google's now going to take $70 billion and buy $70 billion worth of stock, essentially removing those shares from supply. If you remove supply from the equation and you've increased demand by offering a dividend to bring in more buyers, your share price is probably going to go up significantly. Does it help the bottom line business? Probably not, but it's going to impact share price. So I look at this as great news for Google, but the bad news, I got the great news is these two things, the 5% dividend increase and $70 billion stock buyback. The bad news is that the executives, the powers that be at Google, have said, we don't see the potential for increasing our growth by investing in the business. So we're going to give that as dividends and buy back shares. That, to me, is a red flag for Google. Now, it's a red flag for Google as far as earnings and profits. It's a green flag for investors, because remember what happens during a share buyback. They are taking shares out of circulation. When you do that and demand increases, prices should surge. So what does that put us with Google? Right now in the after-hour session, we're up 4.6%. We're currently trading at 168, which is this light little line up here at the top. I will highlight that one for you. And boom, that's where we are currently. Exactly, Oliver. Net earnings won't be good. That's the thinking that I have here. And you notice what's gone on with Google over the past few months. I mean, it's not been a rosy situation, and that certainly is the case for most of the tech stocks out there. At one point, they were down 31.64%. Right now, off its ATH, 22.52%. So this sounds good for Google. My guess is this is going to bring in a lot of buying for it, but it raises a lot of questions. I don't want to see them offer a dividend. I'd rather them take that $70 billion and do something to grow earnings. Buying back shares does not grow earnings at all. It just juices the stock share price because it removes some from supply. So this is accounting shenanigans, in my opinion, but a telling sign that Google feels it's better to pay that profit out to the shareholders than invest it in the business. I don't think that's a very positive sign. I may be corrected here. Maybe I should bring Colin Teddards on the show and talk about that. I'll see if I can reach out to him and get him on the program, because to me, this is a kind of a red flag from an economic perspective. And that may reflect the market uncertainty, right? We do have a lot of questions about where this market may be in 3 months, 6 months, a year. I mean, honestly, we just don't know from day to day now. So kind of sketchy with what's going on with Google. All right, what comments? Did I ruffle any feathers? What about Google's robotaxi? Shouldn't that drive growth? I think certainly it could impact with Waymo. That certainly will have an impact. I don't know how much of an impact, but yeah, that certainly could be a good thing. And one good thing about Google is they've bought into many, many, many different businesses. However, if they still thought the economy was going to do well, they would take that $70 billion and buy another business, buy some other industry, buy some AI, buy some tech, but they're not. That's concerning. What new things does Google do or make, though? Here's a couple interesting things to think about when you look at tech. I'll use NVIDIA for example. NVIDIA sells the pieces, the picks and shovels, right? So let me go back to a really archaic example here to hopefully get I know we have a lot of new followers here as well. So if you are new, hit that subscribe button. But let me come up with a really basic example about something that those of us in California know very, very, very well. The gold rush. I'm kidding. I'm not that old. So if you look at the gold rush, what happened? You had a guy who would set up in the Sierra Nevada mountains, and he's got dynamite, he sells picks, he sells shovels, he sells all the sifting tools. You need something for your gold mine, I will take care of you. Now, the good news from that business perspective is that guy knows who's making money. He knows who's hit the vein, who's got it. How do we know? Because he's buying all this extra equipment, and maybe I'm the guy who's buying gold from them. So in that analogy, if let's say I've got 50 mines in the foothills of the Sierra Nevadas, and I'm the main dealer where everyone's buying all their picks and shovels, I know who's expanding and really going at it. If I see that they're pulling gold out of those mines, then I'm going to go in and say, listen, I'll invest in your mine, but I want to cut to the action and help them. And many of those gold miners might say, sure. Look at NVIDIA the same way. NVIDIA sells the pieces, the technology that every AI firm needs. Every one of them, without question, needs the technology that NVIDIA offers. NVIDIA's representatives, their account executives, are working with some of the most cutting-edge technology today in the face of AI, whether that is robotics, whether that's different learning systems, large language models, you name it. There are technologies that we probably haven't even seen yet that NVIDIA is doing business with right now. And NVIDIA, when they see someone that's got a novel idea that's just absolutely fantastic, will buy that company, right? NVIDIA has a whole portfolio of different companies they're invested in or own outright. To me, I feel like kind of the same thing Google has done for many, many, many years. And this is why I'm concerned with Google's earnings. Is I would much rather them take that $70 billion and buy into something else. Keep diversifying their model, because to that comment, what else do they do? Well, they have a lot of other small little businesses, but the more tentacles they have in the financial markets, different business ventures, then the more they can stabilize their earnings and prevent them from having a catastrophic shock if ad revenue falls or if cloud storage declines significantly, as it's declined a little bit. But you can't rely on one thing. Jay Powell says, could the decision to increase dividend be a signal of anticipated slower future growth period? Yep. I think that's a big part of it, right? They're trying to entice people to come and buy their shares. All right, Chase says, what weight do you give USM to money supply? It looks like it's just out of the 2020 high and the most recent readings moving up well off the bottom of 23. Bullish bias for the markets. Look, the more you increase money supply, the more that theoretically improves business. However, it gets to the point that we start to increase inflationary data as well. More money, more problems, as Biggie Smalls used to say. So if we increase money supply and get back up to our highs, which we're getting closer to, what does that do to the value of the dollar? It decreases the value of the dollar, right? You print more money, you decrease the value of the dollar. Here's your dollar index. Oh, this is not the dollar index, that's the DAX. Let me bring up the dollar index for you. I think that we can see that reflected here, right? We have seen a tremendous decline in the value of the U.S. dollar purchasing power around the world from 110 all the way down to 98, right? That's a giant drop in purchasing power. And I think that is reflected in, number one, the uncertainty. Number two, maybe some of the global hostility that's being thrown around to the United States, and rightfully so. And then the other one could be the increasing of money supply. So when I see this, and your comment earlier, Chase, this makes me feel like inflation is certainly going to be rearing its head, probably in Q3, not Q2, but I think Q3 is when we're like, inflation is really looking bad, right? And again, that's just opinion, but these data points will lead us to a prognosis, if you will, of the market. All right, what do we got? Oliver says, has to compete with Tesla. It does compete with Tesla. So if you're talking about Waymo, which is a Google product, and then Robotaxi, which is Tesla, they are competing, but right now, technically, Waymo's ahead. Waymo has the permits, and they're actually driving around right now, but I think, again, the relationship that Elon Musk has built with President Trump, it would not surprise me at all if President Trump were to contact the transportation authorities and be like, hey, you need to get Tesla on Robotaxi going. Let's fast track this. I think that he's going to get some preferential treatment there. And again, I think that'll be a boost for Tesla's shares over the next year. What else? Google has absolutely everything from search engine to cloud, advertising. Yep, they got so much stuff. This is where I think you have to look at a company's value. Like a lot of times we look at a company name and go, oh, okay, it's Facebook, right? They're just a a social media platform. No, Facebook has so much other stuff that if search engine starts, or let's say social media starts to decline or there's a new one, well, Facebook may buy it like they did Instagram, or they could buy other companies out there and diversify their holdings. So even if one of them falls out of favor, you got all the others to bail you out. To me, that is a great way that most businesses should be doing to diversify their holdings and protect themselves in that case. Let's see. Okay, I think I got most of the questions. If you can't tell, I'm a huge Google fan. Hey, I'm a big Google fan as well. Don't get me wrong. When I look at the chart, though, I have to be a little bit skeptical here just based off what's going on. So let's run through our Magnificent Seven, right? Just to see how these big tech stocks stack up against each other. And I know they're certainly not apples to apples, no pun intended, because I'm about to look at Apple first. But we'll look here at the Magnificent Seven, and I'm going to keep the same time frame. We will do all the way, let's do from January 2023 to today, right? So we're going a little over 2 years. So we'll start at the bottom here with Apple. Chart looks really bad. Of course, we know the entire market looks like this, but I'm going to use this low point from back in April of 2024. April 22nd to be precise. Apple bottomed out around 165. We got close to that a couple weeks ago, right? We came all the way down about 171 and now we're back at 208. So grand scheme of things, uptrend for Apple, pulling back to a pretty low demand zone here, but all in all, still in a major uptrend. Google's an even better picture in my opinion. However, the break of this low here on September 10th is pretty bad. September 10th of last year, 2024. It would take a while to get back to these March lows where we saw Apple have that similar bottom price back in April. Meta, probably the better of the three so far. Stronger uptrend, not even close back to these March lows. Could make the argument that we're sitting right at this demand zone or right around 491. So out of these three so far, Meta looks the best as a long-term growth play. Amazon, not back towards those lows. The low here is actually in August of 2024. Still a beautiful uptrend, big pullback, although I don't really see demand being a factor on this one. Microsoft looking the worst so far out of all of these, right? And that's because it broke these lows from November of 2023. Even though this is Microsoft, it's still showing much weaker, less growth from a share price perspective than we saw in the other three or four. Making 17.35% in Apple. Are you talking that's your gain for the year, Margaret? And then you have Tesla. Tesla doesn't look anything like these other ones, right? It was really just chopping along from 2023 into 2024, and then once the election results were in the end of 2024, we saw that huge surge up, and now it's back to flat. Really kind of feels like it's just not that exciting for this year. So this is the ugliest picture of them all, even though long-term I do have a very long-term positive outlook on Tesla. Right now it looks like trash. And lastly, NVIDIA. So NVIDIA is similar to what we saw with Apple. It's coming back down to some of those lows to go back into last year. We saw it kind of double dip here on the August low, although it didn't reach the April lows that we saw with Apple. So this one looks a little bit better. I think all tech is going to be suffering like this until we can kind of get the trade issue out of the way, get some tariff issues resolved, and then they'll probably rally back to the upside. So they all look pretty bad. Out of all of those, though, which one do I say look the best? Amazon looking pretty dang good, and Meta from a trend perspective. Good for you, Margaret. 17.35%. Gotta love that. Again, I emphasize this one maybe a bit too much tomorrow, that for those of you who are, you're holding on some gains, small gains, or even large gains, you just look what the market's doing. Here's your S&P 500 to where we are today. Market's down 10.63%. So if you're anywhere above that, you're doing good. So if you got 17.35% in Apple and it's down 20+%, you're doing phenomenal. Love it. Good job, Margaret. Good job. All right, what else did I have to discuss today? There's other earnings to speak of. Yes, I have a little chessboard out here with earnings because Intel had ridiculous earnings. Redonkulous earnings. They were supposed to make 1 penny per share. Here's Intel, one of the largest CPU companies in the world, making 1 penny per share. Now, I have to say, the company's making 1 penny per share. I really don't have much of an interest in holding those shares. That's just not enough profit. However, they came out with 13 cents per share, and they're down 4.7%. This is why earnings suck, folks. They shattered earnings. They absolutely crushed it. On any other piece of paper, you'd be going, oh my goodness, I've got to buy some Intel. And maybe you do long term. I know Colin Teddards and myself have both talked about Intel being not necessarily takeovers, but maybe an acquisition target for other chip makers as they transition from a CPU to GPU. Daily time frame here. Here's your daily chart. It don't look good, right? Intel is just kind of languishing, sticking near the bottom. It almost feels like if you're looking at that $19 price point for Intel, that's kind of the floor. I know we breached it a couple times, but let me put a line right here across the bottom. And there you go. 1851 is kind of that low point that you see going all the way back into 2024, where it's bounced off it over and over and over and over, except for that little breach we had here on that big sell-off on April 7th and 8th. To me, that might be a great put selling point is at 1850. It feels like there's just kind of this hand preventing it from going lower than that. I'll let you know tomorrow. If I have some time in the morning, I may actually look at selling some puts at the 1850 strike on Intel, see what kind of premium I can get there. But yeah, Steve's their own Intel, and they're an S-word show. 1 penny, you kidding me? It is awful. It is awful. And especially for a company that's received billions. I mean, not a million. We're talking multiple billions of dollars from the government to build infrastructure. Now, in this push to wean ourselves off of China tech, Asian tech, South Korea, Taiwan Semiconductors and things like that, it's good. I think that the U.S. should invest in infrastructure to bring chip manufacturing back to the United States, but you're just not going to get the cost that you could at something like TSM, Taiwan Semiconductor. So here's TSM's chart. Looking absolutely terrible, at least over the past couple of weeks. Let's go from their peak to their bottom, just so we can kind of see how it stacks up with the other equity markets. 40%. At one point, TSM was a 40% discount. Honestly, buying Taiwan Semiconductor at $134 per share looked pretty damn good. I think that would have been a great buy point. And also, it came back to this climactic moment back on August 5th of last year, where let me bring on volume here. You had a monstrous sell-off on August of that, back way in the back. Oh, adding on all kinds of different indicators for you. So what did you ask me, Margaret? Do I think it's bottom? NVIDIA or Taiwan Semiconductor should get that infrastructure. They did. Taiwan Semiconductor did get some money, and I know that they are building factories, but, I love how people have this expectation that, we're going to build a factory, and you snap your fingers and it's up in 2 or 3 days. Especially when you're dealing with, what do they call it? I'm spacing on the name. It's clean room. When you have to go into a clean room for these manufacturers of chips, right, where there's just no particles, no dust, nothing floating around in there because that could contaminate it. Those are expensive processes, especially when those clean rooms are the size of football fields. This takes years. So the sooner it happens, the better it's going to be for tech and semiconductors, which have been struggling lately. Let's bring up SMH here, which is your semiconductor ETF. Going back to its highs, which are back in July of 2024 to our low, chips were down roughly 40%. Now, they're bouncing, looking good here, and maybe if you are optimistic in tech, that you could look at the chip sector as more opportunity. TSC has a huge factory in Phoenix. It's not open yet, is it? And I think you mean TSM, right? Taiwan Semiconductor. Is that what you're talking about? So Taiwan Semiconductor, I know, has a big factory that I don't think it's open. I believe it's waiting to open, right? Correct me if I'm wrong, Stephen, but I'm pretty sure that they have not completed that factory yet. It's running at 20%. Okay. Hey, 20% is better than nothing, but that's still, if you're a trader, that's an 80% loss. And hopefully they'll get that up to speed faster and faster. But I know Intel's got some in Texas, and I think I did a special on this a while back, but Steve says it's supposed to be full go in 2026. The sooner the better, right? The sooner the better. Mike says, I took a flyer on calls for tomorrow at strike of 2022 on great earnings. What a disappointment. Yeah, I kind of thought they would have good earnings too, but that Intel chart looks awful. I mean, it looks really, 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 really bad. All right, that's kind of the big stuff out there. Let me run through your economic calendar. I have a live studio audience here today in my house, just so you know. We're on the couch. I think he's asleep right now, but it's fine. My friend from NorCal over there in my upstairs studio today. So I'm going to wrap this up. I was going to say we're going to go to the beach, but unfortunately the beach weather sucks today. But we'll go down there and have some food on the beach. Let me go into your economic calendar and earnings calendar for Friday. Again, I will not be doing a show on Friday. If you can see on this screen here, not a lot of big stuff happening for the U.S. You really have University of Michigan consumer sentiment reports, inflation expectations, and I would say that that's probably it. For Canada, you got retail sales. You have the Swiss National Bank, if you're trading the Swiss franc at all. You have British pound retail sales. So, kind of a quiet day. I think it'll be more of a digest this week's actions. And of course, tomorrow it'll all be about Google impacting the earnings scene. Here you can see the earnings. Man, Intel, 13 cents earned versus an estimate of 1 penny, and they're down 6%. That is pretty rough. Let's go to tomorrow's to give you an idea. Just because it's Friday doesn't mean there's nothing going on. You have tomorrow, you got AbbVie, Schlumberger, HCA Healthcare, you got Phillips 66, you got Colgate-Palmolive. Yeah, that's pretty much it. I thought we had Sintra. Well, maybe CL. All right, so that's your earnings. That's your macroeconomics. What did Mike say? Merlin beach weather may suck, but you still have. Yes, that's true. There'll never be a shortage of eye candy at the beach, regardless of what your orientation is. Yeah, always something fun there. Future topic, gold-backed bonds. Okay, you know what? It might be interesting to bring John O'Donnell. It was his birthday on Monday, and I did not wish him a happy birthday, so I will reach out to him here later today and wish him a happy birthday. But maybe I'll bring John on, because John's been that gold bug for many, 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 many years, and I think he'd really have a lot to say about gold-backed bonds. So yeah, I like that topic, Jeff. I'll look into adding that one to the calendar. That said, that's going to do it for me, everybody. I know that you guys are going to miss me tomorrow. Try not to shed too many tears. I hopefully will make it back. And my hope is that on Monday, we'll get our 5th bullish day in a row. Actually, I'll be honest. I hope tomorrow's a bearish day. I have a bunch of puts that are in the money right now on SMCI. And I want SMCI to tank tomorrow. I want MicroStrategy to stay right where it's at. NVIDIA stay right where it's at. So hopefully it'll all pan out. But either way, those will probably be the only trades because I got them executing out tomorrow on SMCI, NVIDIA, and MicroStrategy. But maybe some Intel tomorrow. Wear a mask? Nah, Margaret. COVID's part of the fun. I think I've got COVID twice at a Fish concert. Let's see if it happens again. But I will see you guys on Monday. Have a fantastic weekend. If you have any thoughts, topics, things you want me to discuss on our Monday show, you can email me, tradermerlin@gmail.com. Send them on in there, and I will see everybody on Monday. Have a great weekend. Take care.